Thank you for standing by, and welcome to the Seplat Petroleum Preliminary Results 2016 conference call. At this time, all participants are in listen-only mode. There'll be a presentation followed by a question-and-answer session, at which time, if you wish to ask a question, you'll need to press star 1 on your telephone and wait for your name to be announced. I must advise you this conference is being recorded today, Thursday, 30th of March 2017. Now to hand the conference over to speak today, Austin Aburu, Chief Executive Officer of Seplat Petroleum. Please go ahead.
Thank you. Good morning, everyone, and welcome to our results announcement for full year 2016. Let me start by introducing a new technical director, Jay Smulders. It's the first time you'll be listening to him, and he will give all the operational details after the highlights that I will put out very shortly. And to also announce that our SY Chief Operating Officer, Stuart Connell, who we have known over these past 6 years, retires at midnight tomorrow from the board. 2016 performance has been underpinned by one key event. The outage of the transfer cables for most of the year, starting February last year. Quite unprecedented, still out at this time, but that actually defined almost everything that we did in 2016. And so you will see our working interest production was just under 26,000 barrels equivalent per day, which of course doesn't reflect our full potential. You see the details in the operational review. Our net working interest 2P reserves this time is almost flat at 462 million barrels equivalent. When you add 2C to that, it goes up to 552 million barrels equivalent. We have continually brought down our cost. The things under our control, we have worked very hard on them. Our unit production cost is just around $9 per barrel equivalent. In terms of revenue, you will see also in the financial details, total revenue of $254 million. You will see, again, the impact of the transfer cables outage and very low oil production. Gross profit, $72 million. But profit after tax, actually a loss of $166 million after tax. But cash flow from operations stood at $172 million. Capex spend, which we curtailed tremendously, stood at $52 million. Again, but this shows that even under those very strong headwinds, we're generating more cash than our Capex spend. We've continued to deleverage. Gross debt to this at the end of the year stood at $676 million, down from $1 billion, and cash at bank of $160 million. Again, you see the details of that in the financial report. As I said, the entire result has been underpinned by export route, or the lack of it. And so we are in the process of establishing a lot of alternatives, export routes. We have established long-term export route via the water refinery. Recall that over these years, we set up a pipeline to the water refinery, and we then had to react to the outage of transfer cables by getting approval to use the water refinery as an export terminal. And during the year, we were able to barge modest volumes out of that the water refinery. But right now, what we're then doing, we're embarking on some engineering upgrades to more than double the volume we can export through the water refinery. We're also supporting government to complete the long-running movement to Escravos Chevron pipeline, which will offer a third export route. I'll talk about this very shortly. Our gas business, we topped the $100 million mark, revenue from gas this time around. So we demonstrate our promises in the past 5 years about building our gas business. We continue to do that. The Oben gas plant, phase 2 expansion, which is just being commissioned as we speak, takes our overall processing capacity to 525 million scf of gas a day. We have in fact established a major processing and distribution hub for domestic gas in the West by this expansion. It also gives us headroom that by the time we're fully back on production, we will be able to do about 400 million scf of gas a day. So that gives us over 100 million scf of headroom to handle third-party gas as it comes in. So our outlook for 2017, again, responds to the headwinds that we had in 2016. As we put it, we have drawn a line under 2016. And moving forward, there are critical steps we're taking to make sure that no matter the circumstances, we will have alternatives to the difficulties we had in 2016. So from the point of view of the export route, which has been a major headache, we're establishing 3 different alternatives. The Trans-Forcados itself, and we're working with all parties in the Western Niger Delta with Shell to bring back the Trans-Forcados pipeline. But in addition to that, as I just mentioned shortly earlier, we are working with NNPC and Chevron to also get the Amukpe to Chevron Escravos export pipeline up and running. That can take all of our production once that is running. We are also doing, as we started exporting through the water refinery, we found out that there were some engineering limitations. Recall that the refinery itself is not under operational control. So we, through having secured the approval of NNPC, we're embarking on some major engineering upgrades, which will allow us to export 30,000 barrels a day out of water refinery. So when you put all 3 together, what we'll have will be 3 available alternatives for export through Escravos, through Forcados, and through barging at all times. Of course, we will, once these are sorted out, export routes are sorted out, we will optimize our production from all our assets. When we come back on full production, you'll find out that we would have dewatered completely our production from the Western assets, which means we will be exporting export quality crude, which again makes it much easier for us to batch and also reduces, of course, our crude handling charges. Of course, we'll ensure our operations remain safe and secure. Financial point of view, the finance team has worked very hard during these very difficult times to preserve liquidity. As you saw in my summary, at the end of the year, we still had $160 million cash at bank. There's a lot of work being done to ensure that at all times, the setting minimum liquidity buffer is available for our operations. And so we allocate capital only to the most critical short cycle items under our control, which is also why you saw we were able to maintain Capex spend at a very low level of $52 million. $52 million. We'll continue to deleverage the balance sheet. Again, you hear the details during the financial presentation, but we are putting everything in place to completely retire the legacy and PDC receivables and also optimize our capital structure. While maintaining a lot of discretion and flexibility over how we spend or what we spend on. And so particularly Capex commitments, we keep them to the minimum and remain very flexible to be able to either increase or reduce those spends depending on what happens. So our work program, which is approved both by partners and the board, is flexible to the point where we can dial up or dial down the program as appropriate. Our gas business, as I said, we have now delivered the optimum processing capacity that we intended to at Oben, having established then more than half a BCF of processing capacity in the West. We are going ahead to establish another processing node in the East through the ANO project, and FID will be taken later in the year on that, which will then establish the second node in the East, and eventually in the fullness of time, between these 2 nodes, we will have a domineering control as an operator of domestic gas processing and supply. And so during 2017, we intend to complete a few other gas projects. Our Seplat gas plant, which has nameplate capacity of 60 million scf today, we're completely rehabilitating that. Our Oben compression, we're also finalizing that, which will then, instead of flaring any gas in Oben, we'll actually be putting about 50 million scf of associated gas into the sales line. So our 2017 outlook, as I said, captures the critical strategic priorities that enable us to draw a line on that 2016 and make sure that headwinds such as we saw in 2016 will come completely under our control going forward. Let me now invite Jay to give you the operational details. Thank you.
Yes, good morning. My name is Jay Smulders, the Technical Director of Seplat, and I will be providing you with the Seplat 2016 operational update. In summary, due to the continued unavailability of the Forcados export route, the 2016 update is mostly about the potential of our portfolio, but also demonstrating the underlying strength of our assets, focus on unlocking the production, creating viable and reliable alternative export routes, and our gas development. So first, looking at our production. As you can see, the company has been able to deliver a steady growth in both oil and gas production up to this year. This year, production is obviously affected by the force majeure at the Forcados terminal. Liquids production was most severely impacted, down 65% year-on-year to just over 10,000 barrels a day. But the gas production is more resilient. Initially, it was impacted as our condensate export was injected with the crude oil export through Forcados. However, we were able to initiate liquid export by the Refinery and actually increase our gas production by 10% and deliver over 200 million scf a day, which is close to 100 million net to Seplat. So the numbers we see here are not really the picture of what our portfolio is capable of. Towards the end of 2015 and the first couple of months in 2016, we were producing 52,000 barrels of oil equivalent. And if we would project a kind of more normalized production, then we could have delivered 48,000 barrels of oil this year, which would have been higher than the 43 we delivered last year. However, regarding the production forecast in 2017, whilst the terminal in Forcados is still on force majeure, we're not able to provide you any guidance. But as soon as the production is re-established and we have sight on a more reliable production forecast, we'll provide you with an update. Then looking at the reserves and resources, despite the production and distribution challenges with our export routes, there are no material changes in our subsurface views. This underscores the quality of our asset base and strong fundamentals of our portfolio. We have good running room for production. A good portion of our 2P oil reserves are developed, and we have projects such as Seplat Shallow and Ohadi South that can offset the natural depletion and offer incremental organic growth to our portfolio. On the gas side, we have significant undeveloped resources based at OML 53, and that will give us a lot of headroom to boost contracted gas sales in the future. A bit about the reserve movement. Well, we didn't have a lot of production, so if we reconcile the year-on-year movement beyond volumes, we see a net revision downwards of around 8 million barrels, and that is due to the reassessment of the booked reserves attributed to OML 55. The commercial terms that we have agreed have been revised and agreed a discharge sum of $330 million US, which has been set as a payable to Seplat from production, and that is now reflected in the reserves number. Other than these reserves, at the OMLs 4, 38 and 41, they were just flat with a adjustment for production. However, on the positive side, the reserves at OML 53 were increased by 26% year-on-year and are now standing at 670 BCF. Our 2C resource base is pretty much equally split between oil and gas at 19 million barrels equivalent, and that brings our total resources to over 550 million barrels of oil equivalent. And talking about the reserves growth, I think we have demonstrated a consistent track record of growing our reserves, both organically and through inorganic means or acquisitions. Since 2010, we've converted over 100 million barrels of oil and over 80 million barrels of gas equivalent from 2C to 2P reserves. And alongside the acquisitions of OPL 283, 53 and 55, we've added another 60 million barrels of oil and 137 million barrels of gas equivalent. So we will continue to capitalize on our 2C to 2P opportunities with the existing portfolio and leverage our strong record of delivery. Maybe a bit more around our export routes. If we start on the east, the OML or OPL 283 and OML 53 both export through the Brass terminal, and that has had an availability of greater than 90% this year. And OPL 283 has the additional flexibility of exporting through Forcados when that's back up. The OML 55 block is exported through Bonny, and that had a greater than 80% availability. So our western assets have been performing quite well, even in 2016. And the real challenge has been around our western production, which is also the bulk of our oil production. So Forcados has been down since February, but is expected to come up again at some point this year. And then we are ensuring that we're no longer solely dependent on the Forcados export route. So early in the year, around May, we managed to do some work in the water refinery. That is originally designed as an import crude facility for the refining process, and we did some minor modification work and piping reconfiguration to allow us to export to the terminal and now simultaneously produce into the tanks and load vessels. And on top of that, we have engaged into upgrading 2 of the jetties. The third option we're working on is a Amukpe to Escravos pipeline. That is a joint venture pipeline owned by the government that is almost complete and has a capacity of about 160,000 barrels a day. That requires some further completion work at the tie-in end. We are very close to the pipeline, hundreds of meters, and the connecting the end of the pipeline into the Escravos tank farm. We are in discussions with the related parties, and we are now getting engaged with the completion of that work, as well as putting commercial agreements in place for the transport of our crude and export through the Escravos terminal. So that means with Forcados coming back online, we will then have 3 export routes, and we will retain the water refinery export routes even when Forcados is operational. Maybe a bit more details on what's happening around the refinery. As I said, we have done the initial step of reconfiguring some of the piping work to allow us to export to the vessels from our facilities in the OML 438 and 41. And we're currently upgrading 2 jetties. One of them is near completion and should be completed by the end of April, which means by May we should be able to increase the frequency of loading and achieve about a 30,000 barrel a day export. The second jetty will be completed in the second quarter of this year, and that will then allow us to provide reliable export from the water refinery. Another benefit of the refinery is that volumes are not subject to the reconciliation losses injectors are charged when using the Forcados terminal. So for us, these losses are around 10 to 12% of every barrel, so this is a significant economic factor. In addition to the jetty works, also already mentioned that we have completed the water treatment facilities, which means we can deliver crude exports at a dry spec, and that means higher volumes can be exported through the Refinery, but also eliminating water handling costs when we do use the Forcados terminal again. Talking a bit about our gas business. We've made quite a bit of progress in 2016 with the work we did at our open gas facilities. And if you look at the three graphs on the left, you can see the continuing trend. We're now managed to generate over $100 million in revenues. And these were driven both by higher production volumes, but also by higher pricing. Our gas reserves picture shows that we have a strong resource base, which will enable us to increase gas sales into the domestic market with long-term contracts. If we then move to the map, you can see that the open facilities are strategically located in the heart of the main infrastructure, which gives us access to both demand centers in Lagos and Abuja. And the government is currently constructing the OB3 pipeline connecting to the central and eastern assets, which will then allow us to route any gas from our OML 53 to the open link into, again, the same Lagos and Abuja markets. The ANO project is a critical future gas supply project for Nigeria, and it is under discussion with our partners in the unitized ANO development, and that is with Shell, who is the operator of OML 21. We're planning to finalize the framework on how we are going to operate the upstream and midstream elements of this project so that we can take FID this year. And when we have reached FID, we will update you on our plans on delivering one of the most exciting and largest gas projects for Nigeria. Moving back a bit to the west, talking around our open gas plants. 2016 really was a lot about increasing capacity. We have added another 225 million scf to the facilities, which takes our total capacity to 465 million cubic feet a day. And together with the 60 million cubic feet of our Seplat plant, the total western capacity is increased to 525 million cubic feet. The expansion of the open plant is on time and on budget. We are in the final stages of commissioning, and we will plan to start operations in Q2 of this year. And that means we are in the position to start securing additional gas contracts for sale, as our wells are able to deliver around 400 million cubic feet a day on gas. The additional capacity that the plant offers gives opportunity to third-party volumes and tariff income. So how does gas capacity then relate to the contracted volumes? If you look at the diagram on the right-hand side, it shows how we have built capacity at open to our current levels over time. And a benefit to us at the moment is that the Nigerian gas market has strong overall fundamentals. That means that the gas demand outstrips the supply. So that has driven up the pricing, and the current regulated pricing stands at $2.50 per 1,000 cubic feet, and the free market pricing has moved beyond the $3.50 per 1,000 cubic feet. And then in the table on the left, it shows the contracted gas volumes as of today, which is a mix of firm supply and interruptible, that gives us the ability to maximize gas production from our western hub. One of the key attractions of the gas business is that it's readily scalable. It's easy to add in units and to increase capacity. And in addition, the gas pricing are US dollar indexed and dealing from oil, which gives us added diversification and lower volatility of a significant portion of our revenue. So then I'd like to take you to some of our key highlights for 2017. Our immediate focus, as earlier discussed, is really around unlocking our production, and that means we have to and will complete the work at the Warrior Refinery with the jetty upgrades, which will provide us reliable export of around 50% of our production capacity. And when the Forcados terminal is open, we will restore our production quickly to the original levels. And if you might remember, in November, when we were briefly up for a number of days, we demonstrated we got our full production back in a couple of days. So our facilities are still capable of producing the levels that we kind of left off with in February of last year. In parallel, we continue to pursue the Escravos pipeline option that we also plan to have available this year, so that we'll have 3 reliable alternatives to export from our western assets. A kind of a small item is that we have not completed the full commissioning of our water treatment facilities because we need a full flow performance test. And unfortunately, we did not have enough production last year to do that, so we'll complete that this year as soon as we continue our production. Around our development activities in 2017, again, we have very few commitments, so it is a discretionary program, but at the same time, we have a portfolio of options available to us that we can execute and start quickly. Such as our Seplat shallow reserves that we can bring online quite quickly, and the Ohaji South oil leg. And in parallel, we will continue to drive our gas business. So with the increase of capacity of our western or open gas facilities, we'll be putting in gas sales contracts to increase sales from the facilities. We will bring the ANO project to final investment decision this year, and we will complete some of the additional small projects of associated gas compression and the Seplat gas rehabilitation. That concludes my operational update, and at this point I'd like to hand over to Roger Brown, our CFO, who will provide you with the financial update.
Yeah. Thanks, Jay. Looking at the financial summary, obviously we spent a lot of time in the last 18 months adjusting to the lower oil price environment. But really, the big news on these numbers is the impact of the force majeure events in 2016. So if we look at our revenue line, they're down on last year at 254 versus 570, making up that 254. 149 is oil and 105 is gas. So you're seeing a gas being about 40% of the revenue base. We always worked on gas being sort of 15 to 20%, and as we see our oil returning, which we're forecasting this year, then we'll start to see that mix coming back to where the 15 to 20 range long term. In terms under the cost of sales, that is 182 versus 321. Within that cost of sales, about a third of it is in depreciation, and you'll see that we're slightly up on the crude handling charges because of the barging operation, but obviously we're not getting the impact of reconciliation losses when we barge. Gross profit of 72 for the year, and then we go through then looking at the G&A line, and you can see it trending down in the G&A, so we're starting to see the continued cost cutting there. We then look at a number of the one-off non-cash items. The big one sits there, which is the you can see the FX loss gain. That arises from translating narrow balances on debtors, and the big part of that is actually government receivables, which is 86 million of that 101, 77 which relates to MPDC. Just below that line you see the interest on receivables, and what that is charging the interest as under the joint operating agreement with the government, and then that adjusts that FX hit down to 35 million. And I'm going to talk to you in a couple of slides about that receivable, and we can explain that in a bit more detail. Then moving on down, finance costs impact slightly higher last year because of refinancing was in place in 2015. This all translates to a loss after tax of $166 million versus a gain last year around that, and it's largely down to the number of the one-off non-cash items. If I turn to the next slide, which will explain the other numbers in more detail, what we do here in this slide is just reconcile the movements in cash throughout the year, and you can see we started off the year in $326 million of cash. Cash flow from operations, and you can see even despite in the force majeure events, you know, reducing the receivable by receiving cash, you can see the 172 million coming in from cash flow from operations. And the important thing here is the dialing down and dialing up of Capex. You can see Capex coming in at 52, well ahead of the cash flow from well behind the cash flow from operations. And then you can see the next bars is basically the servicing of the debt. And so we've continued to do that, and I've got a slide on that in the next couple of slides. But you can see the loan repayments of 187, net interest payable of 73, and then the dividend is actually the 2015 dividend, which is final dividend, which is paid in. Small foreign exchange movement, and therefore the closing cash balance of $160 million. And that's continued. We've continued to manage that into Q1. On the next slide, we just snapshot the last three to 4 years of Capex, and you can see we were very active in 13 or 14, drilling. I mean, particularly in 2014, we drilled 23 wells, and that investment at high oil prices really has allowed us to maintain production in this current environment. So in 15 we had 152 million, and then 2016 we really scaled back and actually targeted all the Capex on the gas projects. So you can see that in the green bar there in 2016. Next slide. So now we look at the receivable, and we've talked a lot about this receivable and the work we've been doing to reduce it. We started in the year with that MPDC receivable at 492, and then that increased by net expenditure in the year of 48 to 540. And then you can see the cash that we received during 2016 of $116 million. In an agreement with the government, we were permitted to hold their share of the gas receipts, and you can see that coming in 2016 at $97 million. And then we've also formally, we utilise the government's pipeline system for crude handling, and we're actually formally offsetting that in the agreement with government. So our headline receivable comes down to 268, and then we look at the impact of the FX loss. So on a net basis, we have an FX loss of 77 million, and then contra interest to that of 48 million. So the net position is 29. Now this is the accounting treatment under IFRS, which we needed to translate this at the year-end rates. Commercially, in discussions with government, we're dealing with this on what we call a functional dollar basis, and therefore commercially we will not approach it this way. We approach it that we account for that receivable in dollars, and therefore we expect that to come back and be insulated from FX movements. And then we have an impairment that at 10, that's really just time value of money, another IFRS requirement to discount that. So the net receivable at the year end was 229, and that's continued to be managed. Next slide. What's very critical, as Austin had said, is managing that liquidity position and positioning the business to adjust and look forward into the future. So if you look at what we've done, in 2015 we completed a $1 billion financing with 2 facilities, a 7-year, $700 million term facility, and a 3-year revolving credit facility. And we'd said that our focus was initially to start with the 7-year facility and look at a reprofiling of that, which we completed at the end of September 2016. And we reprofiled that, but up to date we'd paid back almost $200 million of the 700. And then this year we are focusing on the revolving credit facility, which is $300 million. We'd actually serviced $125 million of that, and we're about to service another $25 million this quarter. So over the last 24 months, we've paid back about a third of our debt, and what that's done is impacted the cash position. So we're in discussions at the minute with our revolving credit facility lenders to look at extending that facility beyond 17, end of 17 to the end of 18, and then we'll look at other longer-term refinancing alternatives. So gross debt at the end of 2016 was 676, and then we have cash and cash equivalents of 160. Reducing that to a net debt position of 516. Just say something about our hedging. We continue to hedge our position, and you can see the impact to the accounts in 2016 hedging. 2017, we've put in place 2 hedges around about 3.7 million barrels on an average price of 48. So just to summarize, we obviously the impact of the force majeure for Cadiz, and critically creating the 2 other export routes will be the critical part of 2017 to return the business to a steady state. That's obviously impacted the revenues. The gas is a good story. It's come up in terms of volumes, and also in prices are now on average of $3 an MSCF. Your flexible work program, being able to adjust the Capex, and that's very critical, and then managing receivables downwards and liquidity positions, very important into 17 and onwards. Okay, so that concludes our presentation, and I'd like to hand it back for question Q&A, please.
Thank you. If you wish to ask a question on the phone line, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the hash key. Once again, that's star 1 if you wish to ask a question. Your first question comes to the line of Michael Alsford of Citigroup. Please go ahead.
Thanks for taking my questions. I've just got a couple if I could. So just, Roger, coming back to sort of the commentary around the MPDC receivables, could you talk a little bit about how you see that receivable reducing through the course of 17? I think you've done clearly a great job of managing that in 16, but I just wonder what the forward agreements are around sort of future cash calls and how, I guess, Seven Energy, etc., are going to be paying for their way going forward. So that would be my first question. And then just secondly, just on the development of OML 53, I might have missed the numbers, but I don't know if can you give any sort of sense as to what the kind of development capex could be and the timing of that sort of spending on a going forward basis. And thirdly, just to talk about the third pipeline route to Skrava. So I was just wondering again, what are the constraints and I guess exact timing on that, and what volumes could you potentially see going down to that western route in the future? Thank you.
Okay. Thanks, Michael, for that. I'll kick off, I guess, with the first one, and then I think Austin and with support from Jay will deal with the other 2. Just on the receivables bit, so obviously that's quite a significant reduction in those receivables, and during 2016 the government continued to make the cash calls as the SAA, which Seven Energy has, was in suspension mode. So That, as you'll have seen, there's a termination of that. We don't know how that's all going to resolve, but in the meantime, government has agreed to continue to make those cash calls through 17 and into 18. So we see a trending down of that to eventually an extinguishing of that receivable.
Yeah, thank you. And Capex on OML 53, as we said, it remains very flexible. But essentially, two key developments in OML 53. The gas condensate development we intend to take FID on, and that's a unitized field with the Shell JV. And also there is a standalone oil development where there is the possibility of drilling a well and re-entering to and establishing independent crude oil production out of OML 53. That's likely to come towards the back end of the year as we start seeing results on all these alternatives that we speak about. So once we come back to full production and full cash flow generation, then we start spiking those activities in OML 53 into activity timetable for 2017. The Escravos pipeline, the timing, internally we're targeting the end of Q2 for this to become available. It can take all of our production. It can actually take much more. It can take 160,000 barrels a day. And in particular, the fact that we can now completely dewater once we finish this commissioning, when we're back on full production, the fact that we can completely dewater our production in the western axis means that we can actually put all of our production into that pipeline to Escravos. So it gives us two routes to take our full production, two options, either Forcados or Escravos, plus the third option, the barging option, which can take half of our production when we finish the work we're doing.
Great, thanks. And sorry, just very quick follow-up, Austin. Just in terms of the differentials or the costs of sending it down to Escravos, is it similar, should I think, to the worry, discounts or costs, or is it going to be less than that?
We don't see any real difference. Crude handling costs that will be negotiated, and again, government NAPIMS is involved in this. Not going to be materially different from the cost to Forcados. We expect the reconciliation volumes to be lower. This time we'll have a lot more control on this pipeline when we start putting our production than on going to Forcados. So the 10-12% losses we suffer on Forcados, we expect that to be substantially lower. But we'll see. The important thing is that hopefully from the second half of the year we'll have full availability of two export routes that can take, each of which can take all of our production.
Great. Thanks very much.
Thank you. Your next question comes to the line of Eldar Devletchin of Renaissance. Please go ahead.
Yes, good morning, gentlemen, and thank you for the opportunity. So just on these pipeline alternatives and the other spending, I understand your work program is flexible, but still, just for us to get a sense of the minimum spend for this year, can you just walk through what is the minimum requirement for completion of gas projects, the Oban plant, what would be your participation, if anything, for the Escravos pipeline, and any other maintenance, drilling or costs that you need to make? So what would be your minimum Capex spend for this year? That would be my first question. And then the second on the gas. So it has become a big part of your business and it's growing, but what are the bottlenecks, particularly on the production side? I understand it's 400 million SCF capacity currently to produce, but how much of it is linked to the oil production? How much of it is associated gas or gas with high condensate components? So with 400, what is the minimum of oil and condensate production that you need to undertake to deliver 400 million cubic feet production? And then maybe just on the production overall for 17, is it fair to assume that from mid-third quarter this year, you will be, assuming everything goes as planned, you will be in a position to produce as you were producing before, or even more with more gas, so like 90 thousand total hydrocarbon per day if these two alternatives are available. Thank you.
All right, thank you. Starting with the last question, we will provide guidance, as we said, once we're back to full evacuation capabilities. We will provide guidance on what the production for the rest of the year will be. We are quite as optimistic as we are on our production by Q3 this year. In terms of gas production, we were able to average 210 million scf, oscillating between 200 and 240 million scf a day during these evacuation bottlenecks. That meant that we had to evacuate 6,000–7,000 barrels of condensate a day. So when we're back on full production, we think that our current asset base gas reserves can support 400 million scf of gas a day, which would then take condensate production up to 10–12,000 barrels. Well within, of course, we normally spike that into our crude, so it will be part of 75 odd barrels a day of liquids. And associated gas in that mix will be in the 40–50 million scf range. The rest of that gas production will be non-associated gas. Again, completely within our control to turn it up or down depending on what happens. Minimum spend, I'll let Roger handle that. Yeah.
Okay, yeah. So on this, I mean, look, we've spent a lot on the gas business in the prior years. So there's very little to spend on gas itself. There's a bit of money to be spent in booster compression, but that's not material. In terms of the use, I think you specifically asked on the cost of the Chevron, the nuclear, the Scravos pipeline system. We're in the process of working through all of that at the minute. We still need to get engaged with the terminal operator, Chevron, to tie it in, and also agree the crude handling. So that's why, it's almost too early. That's why we're really saying H2 for that coming up, and to be determined. We don't think it's material. The pipeline is largely complete anyway. So it's just the cost of tying it in. In terms of other capex, I mean, obviously it is discretionary. We do have natural decline in the wells, but obviously that has been bolstered by condensate production, which in liquid spaces. So, to be honest with you, we haven't set that that guidance for 17 yet. I think we just do. I would look at 2016 levels and just see what it could be, to the extent that you're still in terms of managing capex. If the pipelines all come back up and we see a stabilization of oil price, then you're going to start to see some drilling coming up.
Thank you very much.
Thank you. Your next question comes to the line of Gabenga Charlatan of SPG. Please go ahead.
Yeah, thanks for taking my call. I just have one question, which is still on Capex. I understand that the last time you mentioned that you have a firm and contingent Capex guidance. So I was just trying to see what the guidance is for 2017. We know at this stage you can't really give us a firm one, but at least let's have an idea of what the Capex spend in 2017 and 2018 would be.
Yeah, maybe I'll just answer that one. I think that's what I'm alluding to, is that we're not going to guide at this point in terms of 17. What I'm just sort of steering you towards is look at 2016 levels, and really the swing factor is when you get the alternative export routes coming up and we get back into full production, then we can then start to look at drilling some wells and everything else, and then we can come out with the guidance. So, Gabenga, it's too early at this stage to come out with that.
Thank you. Your next question comes to the line of Pabina Yinkeri of Vativa. Please go ahead.
Good morning, gentlemen. I have just one question. I was just thinking, by the time all three export routes are up and running, what sort of split would you say you would have? I mean, would Forcados be the primary export route, or you favor either the Escravos pipeline as well?
Very good question. One of them has to be our primary export route. We'll make a decision between the Escravos route and the Forcados route. We'll make that decision as to which will be our primary route, and then we'll buy a certain capacity in whichever one is our secondary export route, so that we can always swing between the two. And then we'll also continue to badge a certain minimum volume on a continuous basis through Warri Refinery to make sure that also whatever happens, we don't start from scratch. We'll just up the volume if anything happens to the other two. So we're going to manage the distribution of our production essentially between the primary export route and a small volume through Warri Refinery, and then we'll just pay a little bit of fee to buy capacity on the secondary export route.
Okay. From a cost perspective, how would that decision pan out? I mean, I don't know what the cost outlook for Escravos would be. Will it be around Forcados levels better, perhaps? It
should. I mean, tariffs are fast becoming almost a regulated affair to the extent that government is involved in all the negotiations. It's not something that runs through the roof. We will finalize the tariff on Escravos, the negotiations. We don't expect it to be anything outside, substantially outside what we have for the Forcados route. And in terms of buying capacity, it's usually minimal. What you do is you establish a certain minimum capacity and pay only the OPEX element, only the Capex element of that crude handling charge. It's been done in other places. As you saw in this our presentation, our little production from the Pillar asset, their primary export route is this same Forcados route that is down, but because they have a secondary export route through Brass, that's what you're seeing. That little production is the capacity that they had bought on the Brass export route, and so throughout this period that Forcados was down, they were able to export that portion that they had reserved on Brass. So it's something that is well managed commercially, and you end up not having an unduly escalated crude handling charge overall.
Okay, thank you.
Thank you. There are no further questions at this time, sir. I'd like to hand back to Paul for concluding remarks.
Well, so thank you very much, everybody. As I said at the beginning, the key message for us is that at the end of Q2, we should be in a position to draw a line under 2016, and our movement forward will be underpinned by the fact that we've done a lot of work to arrest the headwinds that determined our results in 2016, and hopefully going forward from H2, you should be seeing us working at our full potential. Thank you very much for being here with us this morning.
Thank you. That does conclude our conference for today. Thank you for participating. You may all disconnect.